Today we're taking a look at the ETF called ULTY and whether it's something you should buy, hold, or exit. Let's dive in. First, a bit of background. ULTY is an ETF that pays a high cash distribution. Sounds good at first glance. But here's the catch. The fund maker recently announced that the cash they're paying out is largely return of capital. In plain language, they're paying you money from the fund's capital base, not from fresh income. Fund documents show ULTY has paid very large distributions recently that are increasingly labeled return of capital rather than income. YieldMax reported the October 28, 2025 distribution as 100% return of capital. That return of capital pattern is the main driver of the net asset value decline investors are complaining about. Market commentary calls the yield attractive, but warns net asset value erosion can overwhelm distributions. Multiple independent commentators and data sources document material net asset value erosion for ULT during 2025. Commentaries quantify very large year-to-date net asset value drops and warn that return of capital distributions mechanically reduce net asset value over time. Data services show that the net asset value itself has been falling, so even if market price tracks net asset value closely, returning capital shrinks intrinsic value. ULT is an actively managed option income covered call style ETF that targets high distributions by harvesting option premium. When option income and realized gains are less than the declared distributions, funds may use return of capital to meet payout guidance. The fund prospectus and regulatory filings warn that distributions may include return of capital. Return of capital distributions literally reduce net assets. Repeated return of capital at high rates equals steady net asset value decline, even if market prices briefly bounce. YieldMax's disclosure that a recent distribution was 100% return of capital is a direct signal that cash distributions are being funded by capital, not earnings. Option income strategies depend on selling options and collecting premium. If realized option income falls, funds may still pay distributions by dipping into capital. Several analyst pieces attribute pressure to a mismatch of option income versus declared distributions. When investors see net asset value erosion, they may sell, pushing market price down. Selling can exacerbate the problem if assets under management shrinks. Community discussion shows panic and forced selling narratives. High headline yield is not the same as sustainable earnings yield. If a large portion of distributions is return of capital, headline yield overstates income sustainability. Return of capital can be tax efficient short term, but is economically a return of principal. Over time, repeated return of capital reduces the fund's ability to generate the same cash flow from its shrunken asset base. In U.S. tax rules, return of capital is not taxed as dividend income when received. Instead, it reduces your cost basis and affects future capital gain or loss when you sell. Canadian investors should verify Canada Revenue Agency treatment for foreign fund distributions. What is it for me, and why does that matter? Because when you drain the fund's capital base, the net asset value of the fund goes down. Think of net asset value like the size of a cake. If you keep taking slices without rebaking, the cake shrinks. And that's what many media outlets and analysts are concerned about. Even though you're getting a big payout, your slice of the cake is getting smaller. Check the last few payouts. Are they labeled as return of capital or regular income? For ULTY, the latest payout was 100% return of capital. That means capital is being returned, not earned income. High payout plus capital erosion equals a potential red flag. Check the net asset value trend. Is the net asset value going down significantly? Because if the fund's cake is shrinking, your piece is worth less over time. For ULTY, the net asset value has been dropping. If my goal is to preserve capital, this is a warning sign. I would reduce or exit ULTY. The ongoing return of capital payouts and shrinking net asset value are a structural risk you may not want. If my goal is maximizing income and I accept the risk of shrinking principal, I can hold a small position only. But I must monitor closely. So here's the wrap-up. ULTY can deliver high cash flow, but it carries the hidden risk of capital erosion via return of capital. If you're not comfortable monitoring it closely, your safest route is to exit or scale down. If you are comfortable and your goal is income with risk, take a small position and stay vigilant. So that's where things stand with ULTY right now: the facts, the signals, and what you can do about it. The key is to make decisions based on data. What's real and what's hype. I hope this helped you see the picture more clearly.